Hey everyone, it's Professor Reiko here today, going over, continuing on with our discussion on bonds. All right, so this little section I'm going to do today in this video is it's a little bit special. I typically would only test this in multiple choice, but it is something that is covered, and your teacher will probably cover it as well. All right, so notice up here it says bond issue between interest dates. All right, so usually in accounting classes, everything we do, we do a lot of stuff that happens right on January 1, and so we are dealing with a whole year, and that makes sense from a teaching perspective. But when it gets into the real world, that's not always the case. All right, so what happens if a bond is actually issued on a date other than when we are paying interest? Okay, so let's read how to account for that, and then we'll get going here. So starting up here at the top, it says an adjustment is made for the interest accrued between the last interest payment. Okay, so there was an interest payment prior. How much interest has accrued up to the point of the transaction? So in the date of the current transaction. All right, so here's where it gets a little tricky for some people. All right, it says where the buyer, the person, the investor, pays the amount of that accrued interest that we just calculated plus the purchase price. All right. So you may be thinking to yourself, why would the buyer pay for interest from a period prior to them earning it? All right. Well, the reason they do that is because the buyer is then going to receive the accrued interest that they kind of like almost prepaid for, plus the interest after the purchase, meaning they're going to get paid the entire 6 months interest because they're going to be the bondholder of record on the interest payment date. Right. So they're paying in advance for their interest, but then they're getting all 6 months of it back. So we'll put some numbers to it. But if you think about it, I mean, I tried to explain it in class. If I'm an individual investor, and if you look at the example here, we're going to use 100,000, 8% 10-year bonds. That's similar to what we use in the other videos. Semi-annual interest. The only difference here is they're going to be issued at par on 3/1 on March 1st, so in between dates. All right, so if I think about this, if I'm an investor, and let's just say I'm selling a bond, okay, and I'm going to sell it on 3/1. Well, I was the bondholder of record all of January and all of February. So me, the person selling the bond, would want that interest because that was my interest that I'd earned holding that bond for those 2 months. And so that's kind of an easier way to think about it. So that the person buying it from me is going to pay me for January and February because on July 1st, they're going to be the bondholder record and they'll receive all 6 months of it, even though they only held it for 4 months. Okay, so hopefully that's making sense. But it is confusing for some students, and that's typically why I would not throw this into a bigger problem to test, but I would test it on multiple choice. And notice I have these issued at par, so we get the discount and premium out of it just to kind of clean it up and make it easier. All right, so once again, we've used these bonds before, all right? So we know that the interest payment, so 100,000 times 8% times the 6/12, that equals $4,000. Now that's 4,000 every 6 months. All right, so if we take the 4,000, all right, and divide it by 6, that's going to give us $666.67 per month. And if we multiply it times the 2 months, that's the accrued interest. That's going to equal, and I'm just going to round this, 1333. All right, so this is the accrued interest. All right. So when it says up here, the interest accrued between the last interest date and the date of the current transaction, that is this 1,333 cents. All right. So it's always good to define things and then see it with numbers, but you'll see it. We're doing exactly what we said we were going to do when we kind of read it out in that first paragraph. All right. So, and then if you read, it says where the buyer is going to pay the amount of the accrued interest, 1333, plus the purchase price, 100,000, because they were issued at par. So, meaning on 3/1, they're going to have cash, so accrued interest, plus the face value, or plus the purchase price, I should say. All right. So that is 101,333. All right. We have a bond payable. Always face value. So we're still off with the 1333. And your book, I believe, shows that you can do interest payable or interest expense. I typically just do interest payable. But if you want to say it this way or interest expense, and I'll show you both ways to recover after you do it that way. All right, so notice up here, the amount of the accrued interest, that line right there, is that debit to cash. So notice what it says up there. The buyer pays the amount of the accrued interest, $1333, plus the purchase price, $100,000. Okay, so that's taking care of the first two, that first sentence up there. And now the last sentence is the buyer then receives the accrued interest plus the interest earned after the purchase when the interest payments date is paid. All right, so let's look here. So this will be on July 1st. All right, so I'm going to kind of split my page out here and do interest payable on this side and interest if I had done interest payable on that side. So July 1st. All right, so if I had done it with the credit to interest payable, I would now make that account 0 because now we're paying the interest. I would recognize interest expense for $26.67. Now I'm going to put in parentheses. That's the 4 months from March 1st to 7/1, and then we'll pay out the interest, $4,000. Okay. If we had done it as a credit to interest expense, which usually we are always debiting expense, but if we did it that way, we would credit interest expense, $4,000, and credit cash, $4,000. All right, so the end result, regardless of how we do that. So if we did it this way, interest expense is $26.67, and we pay out cash of $4,000. The payable now becomes 0. If we do it this way, you take the net of those two, interest expense is still $26.67, and we paid out the cash of $4,000. So either way we do it, it's going to end up being fine. So just make sure kind of get an understanding of what your teacher wants. All right. So once again, this is something that typically gives students a little bit of trouble. I usually tell my students if I have a question on this, it will be in the multiple choice. So kind of gauge how much time your professor spends on it so that you can get a better feel for it come test time. All right, so hopefully this helps. So remember, this is only when it's issued between one of the interest dates. Okay, so hopefully you can get a good grasp on that now, and hopefully that will help you come test time. All right, so hope you're enjoying. Please tune in next time as we're going to start switching gears and looking at the effective interest method of amortization, which is probably what your teacher will expect out of you come test time. All right, thanks. We'll see you next time.